Hello everyone, welcome to the 221st episode of me learning how to trade in Forex. So in the last episode we went through what it takes to become an elite trader. So treat trading as a business, draft a business plan which includes a budget for required tools like real-time news and charts, as well as listing the markets, instruments and strategies you'll trade, include realistic monthly and yearly profit targets. Keep accurate, organized, up-to-date record of your trading business. Keep both digital and hard copies of backups of documents such as your trading plan, so description of the plan, inputs, past versions of the plan. Brokerage statements, so organized by the broker, should be reconciled monthly. Your trading journals, so which is a record of your trading activity. Your resources, so list of important phone numbers, economic calendar, list of market holidays, rollover dates, and troubleshooting list. So stay organized in general, have a structured method of conducting research and development for your trading plans, have methodical ways of labeling the different versions of your trading plan, track your taxes and check the trading laws. So become a specialist as early as possible by choosing specific markets and styles that suit your temperament and knowledge base, and control risk before seeking profit. So that's where we got off to last time. Now we're on to choose your information sources wisely. So choose your information sources wisely. It's easy to get caught up in the media circus, watching an endless parade of talking heads spouting opinions that have no bearing on your daily workflow. Instead, turn off the television and subscribe to a real-time news service that gets you the facts, unimpeded by biases or emotion. Add a selective X, formerly Twitter feed, following no more than 75 carefully curated sources, and you'll be watching the same news flow as Wall Street's finest. So specialize in something. Your information sources wisely by subscribing to a real-time news service. By subscribing to a real-time news service that gets you the facts unimpeded by biases or emotion, which gives you the facts unimpeded by biases or emotion. Add a selective Twitter feed following no more than 75 carefully curated sources. Choose a selective X Twitter feed by following no more than 75 carefully chosen sources. But why 75? Is that like a specific number they use at Wall Street as well? And you'll be watching the same news flow as the Wall Street's finest. Find a quality mentor. Now comes the tough part. To become an elite trader, you need to learn from the best. That's a tall order because self-proclaimed gurus are everywhere, hawking in their chat rooms and newsletters. Sadly, few of these folks have the information, experience, or long-term track record you need to raise your trading game to elite status. However, rather than avoiding these folks while seeking a mentor, it's better to sample as many teachers' styles and approaches as possible to find out what works for you and what doesn't. In the process, you'll come across a handful of helpful teachers who will yield a lifetime of trading knowledge. So, find a quality mentor. Better to sample as many, so by sampling as many teachers' styles and approaches as possible to find out what works for you and what doesn't. Find out what works for you and what doesn't. In the process, you'll come across a handful of helpful teachers who will yield a lifetime of trading knowledge. Take care of yourself. Your final task could be the hardest depending on your current lifestyle. Once you've chosen to walk the elite path, you need to monitor personal habits and interpersonal relationships. Drug use, poor nutrition and insomnia undermine the mental faculties required to take money out of the market each day. Add in marital discord or fight with parents, and there will be even more chances for your money and your discipline to be lost through your positions. Understand the deep connection between how you feel and your bottom line results. Financial markets are the worst place to deal with financial issues, so clean up your act and quit smoking, get to the gym and buy your spouse flowers. You've got important work to do and need to be at your best to trade at the top of your game, so take care of yourself by monitoring your personal habits and interpersonal relationships. Drug use, poor nutrition, and insomnia undermine the mental faculties required to make money. Take money out of the market each day. Add in marital discord or fighting parents, and there will be even more chances for your money and discipline to be lost through your positions. Okay, yep. How much does an average day trader make? The average day trader makes between 88,000 to 154,000 a year. This will vary depending on what is traded, how often, and how successfully. What makes a successful trader? There are many qualities that make a successful trader. These include knowledge, not dwelling on past mistakes, learning from mistakes, taking calculated risks, not panicking, understanding the products and markets well, and constant learning. So, traits for a successful trader. So we've got knowledge, not dwelling on past mistakes, learning from mistakes, taking calculated risks, not panicking, understanding the products and markets well, understanding the products and markets well, and constant learning. What is the 80-20 rule in trading? The 80-20 rule in trading states that 20% of the holdings in a portfolio should contribute to 80% of its growth. Conversely, 20% of the holdings can contribute to 80% of the losses. I don't know that was a thing. 80-20 rule states that 20% of the holdings in a portfolio should contribute to 80% of its growth. Conversely, 20% of holdings can contribute to 80% of losses. Fair enough. Bottom line, the elite trader develops a serious approach to the financial markets, weighing risks against potential reward at all times. They hone their craft through detailed record keeping, carefully chosen data sources, well-defined trading edges, and lifelong connections with mentors who will guide them to the next level of achievement. Did I do this one? On to the next. There is a wide range of books available for learning technical analysis, covering topics like chart patterns, crowd psychology, and even trading system development. While many of these books provide outdated but relevant information, there are several books that have become timeless masterpieces when it comes to mastering the art of trading. In this article, we will look at 7 books on technical analysis to help traders and investors better understand the subject and employ the strategy in their own trading. Key takeaways. Many books in the technical trading space are outdated, but several do stand the test of time. Interesting, many books in the technical trading space are outdated. Many books in the technical trading space are outdated, but several do stand the test of time. These classics focus on the fundamentals of technical analysis and are reading charts as insight into market psychology rather than simply listing off an array of patterns. Among the top books for learning technical analysis is Jack Schwager's Getting Started on Technical Analysis and How to Make Money in Stocks by William O'Neill. Getting started in technical analysis. So, getting started in technical analysis. This book is an excellent starting point for novice traders that covers every major topic in technical analysis. In addition to covering chart patterns and technical indicators, the book takes a look at how to choose entry and exit points, developing trading systems, and developing a plan for successful trading. These are all key elements to becoming a successful trader, and there aren't many books that combine all of this advice into a single book. Technical Analysis Explained. Technical Analysis Explained. This book is considered by many to be the Bible of technical analysis, since it contains an exhaustive amount of information covering the core concepts. The book also covers ancillary topics like trading psychology and market mechanics that helps traders understand the why rather than just the how of technical analysis. Despite the wide breadth of knowledge, this book is very approachable and easy to understand for novice traders. Technical Analysis of the Financial Markets by John Murphy. Technical Analysis of the Financial Markets by John Murphy. This book is an approachable introduction to technical analysis that still provides a high level of detail and actionable insights. As a former technical analyst for CNBC with over 40 years of experience in the market, Mr. Murphy has become a leading voice for technical analysis and is highly skilled at conveying complex topics in an easy to understand manner. Novice traders may want to check out this book before diving into more complex topics. Could be first read. How to Make Money in Stocks by William O'Neill. How to Make Money in Stocks. This book is considered a classic work on technical analysis and was written by the founder of Investors Business Daily, one of the most popular investment publications in the world. O'Neill was a strong advocate for technical analysis, having studied over 100 years of stock price movements in researching the book. In the book, he presents a wide range of technical strategies and tips for minimizing risk and finding entry and exit points. Japanese Candlestick Charting Techniques by Steve Neeson. Japanese Candlestick Charting Techniques. This book is a definitive volume on candlestick charting, which is one of the most commonly used technical analysis tools. Prior to Neeson's work, candlestick charting was relatively unknown in the West. He helped publicize the knot technique and train institutional traders and analysts at top investment banking firms. The book offers a thorough explanation of the subject, including explanations of virtually all candlestick patterns that are used by traders today. Encyclopedia of Chart Patterns by Thomas Bukowski. It's not how you spell encyclopedia. That's bad. Encyclopedia. There's no A in there though. Encyclopedia Chart Patterns. This book is truly an encyclopedia that contains an exhaustive list of chart patterns, a statistical overview of how they have performed in predicting future price movements. Let me just read that again. This book is truly an encyclopedia that contains an exhaustive list of chart patterns, a statistical overview of how they performed in predicting future price movements. Mr. Bolkowski is a well-known chartist and technical analyst, and his statistical analysis set the book apart from others that simply show chart patterns and how to spot them. The updated version of the book includes a section on event trading and patterns that occur with news releases. Technical analysis using multiple time frames. Technical analysis using multiple time frames by Brian Shannon. This book has a wide appeal for technical traders because it can be helpful to traders regardless of the strategy that they use. The book highlights the value of applying technical analysis across multiple time frames to identify trades with the highest probability of success. It also goes well beyond what its title implies, and it covers subjects including short selling, stop loss order placement, price target identification, and related topics. The bottom line, there have been many books written on technical analysis, but some of them have become timeless classics that are invaluable to traders. Those new to technical analysis may want to check out these books to fine-tune their strategies and maximize their odds of success. Oh, this is a part of a series, Guide to Technical Analysis. I think it will show up. Guide to Technical Analysis. Wait, I'm getting off topic here. Let's just finish all the other tabs before we're jumping random articles again. So next, this is part of a series as well. Ultimate Trading Guide, Options, Futures and Technical Analysis. So, candlestick charts originated in Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, a Japanese man named Homer discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Candlestick charts show that emotion by visually representing the size of price moves with different colours. Traders use the candlestick to make trading decisions based on irregularly occurring patterns that help forecast the short-term price direction of the price. Candlestick charts show that emotion by visually representing the size of price moves with different colours. Candlestick charts show the emotion of traders by visually representing them by visually representing the size of price moves with different colours. By visually representing the size of price moves with colours. Different colours. Traders use the candlesticks to make trading decisions based on irregularly occurring patterns that help forecast the short-term direction of the price. So key takeaways: traders use candlestick charts to determine possible price movement based on past patterns. Candlesticks are useful when trading as they show 4 price points: open, close, high and low, throughout the period of the trader specifies. Many algorithms are based on the same price information shown in candlestick charts. Emotion often dictates trading, which can be read in candlestick charts. You can read emotions, candlestick charts. Okay, candlestick components. Just like a bar chart, a daily candlestick shows the market's open, high, low and close prices that day. For the day, the candlestick has a wide part called the real body. So this bit here. The real body represents the price range between the open and close of that day's trading. When the real body is filled in, or black, also red, it means the close was lower than the open. If the real body was white or green, it means the close was higher than the open. Traders can alter these colours in their trading platform. For example, candlesticks can be any combination of opposing colours that the trader chooses on some platforms, such as blue and red. On many platforms you can select the colours you want to use. Candlesticks versus bar charts. Just above and below the real body are often seen the vertical lines called the shadows, sometimes referred to as the wicks. The shadows show the high and the low prices of that day's trading. If the upper shadow on the down candle is short, it indicates that the open on that day was near the day's high. So, on the down candle is this one. Whereas if the upper shadow on a down candle is short, so if that is short, indicates that the open on that day, so opening price, is near the day's high. So yeah, short upper shadow on an up day indicates that the close is near the high. The relationship between the day's open, high, low and close determines the look of the daily candlestick. Real bodies can be long or short and black or white. Shadows can be long or short. Bar charts and candlestick charts show the same information just in a different way. Candlestick charts are more visual due to the color coding of the price bars and the thicker real bodies. Highlighting prices this way makes it easier for some traders to view the difference between the open and close. The above chart shows the same exchange traded fund over the same time periods. The lower chart uses colored bars while the upper uses colored candlesticks. Some traders prefer to see the thickness of the real bodies while others prefer the clean look of bar charts. Yeah, fairs. Basic candlestick patterns. Candlesticks are created by up and down movements in the price. While these price movements sometimes appear random, they often form patterns traders use for analysis of trading opportunities or trading purposes. Patterns are separated into two categories, bullish and bearish. Bullish patterns indicate that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. No pattern works all the time, as candlestick patterns represent tendencies and price movements, not guarantees. Let me just write, no patterns work all the time, as candlestick patterns represent tendencies, not guarantees in price movements. Bearish engulfing pattern. A bearish engulfing pattern develops in an uptrend when sellers outnumber buyers. So let's just see if this is written down. Oh, here we go. When the sellers outnumber buyers. This action is reflected by a long red real body engulfing a small green real body. A long red engulfing a small green. This pattern indicates that sellers are back in control and that the price could continue to decline. The second candle engulfs the bullish candle. So this one engulfs this one. This one engulfs this one. Okay, bearish engulfing, here we go. Green candle immediately followed by a red candle. The second candle is so large engulfs the first candle, suggests a strong move downwards. Bearish engulfing pattern develops in an uptrend when sellers outnumber the buyers. This action is reflected by a long red real body engulfing a small green real body. This pattern indicates that sellers are back in control and that the price could continue to decline. So open, close, close, open, close. Okay, so opening price, closing price. Opening price, closing price. So from here to here, open, close, open, close, open. The opening price went up, whilst the closing price went down. So if the opening price went up and the closing price went down, what does that mean? Opening price went up, closing price went down. Opening price went up, closing price went down. So does that mean it opened at whatever, right? But then it closed at a lower price, so the price went down. So therefore the price of the asset has dropped. And if the price of the asset has dropped, that means there must be more supply than demand. Right, that means there's more supply than demand. So there's more supply than demand, then the sellers are in control. Because there's more people trying to sell it than there's people trying to buy it. So the sellers are in control. And then the price falls. Okay, makes sense. Bullish engulfing pattern. Engulfing pattern on the bullish side of the market takes place when buyers outpay sellers. This is reflected in the chart by a long white real body engulfing a small black real body. With bulls having established some control, the price could head higher. So in here, opening close, the closing price is above the opening price, which means the price of the asset has risen. So if the price of the asset has risen, then that means there must be more demand than there is supply. So if there's more demand than supply, that means there's going to be more buyers than the sellers. Therefore, buyers are in control because there's more people trying to buy the asset rather than trying to sell them. Okay, buyers outpace by sellers. Yeah. Okay, next one, bearish evening star. I remember doing this one, I think. Evening star. Okay. Oh, well, they call this one evening star, morning star. Bearish evening star. A reversal pattern usually found at the end of a trend. Alright, okay, so is a morning star bullish then? Right, I see. So that's why I call it bearish evening star. Evening star is a topping pattern. It is identified by the last candle in the pattern opening below the previous day's small real body. The small real body can either be black or white, red or green. The last candle closes deep into the real body of the candle 2 days prior. The pattern shows a stalling of the buyers and then the sellers taking control. More selling could develop. The morning star is the bullish opposite of the evening star. The morning star is a bullish pattern. Right, okay, so evening stars. A reversal pattern usually found at the end of a trend. First candlestick is a bullish candle, part of the recent uptrend. Second candlestick is a small body showing indecision in the market. Can either be bullish or bearish. Third candlestick acts as like a confirmation that the reversal is in place as the candlestick closes beyond the midpoint of the first candlestick. As the candlestick O closes beyond the midpoint of the first candlestick. So beyond that middle of the white candlestick. Last candle closes deep into the real body of the candle 2 days prior, 1, 2, so this one here. By the last candle in the pattern opening below the previous day's small is identified by the last candle in the pattern. So this one, opening, opening here, opening below the previous day's small real body. So opening below this one here. So opening below whatever this one is. Open, yep. The small real body can either be a black or white, so red or green candle. The last candle closes deep into the real body of the candle 2 days prior. So this candle closes deep into the candle, this candle here. Pattern shows the stalling of the buyers. So this candle here, there's a open closing, so the closing is above the opening, which is good. So price shows it's going up. But then this candlestick shows the opening and closing are very close together. So but the closing price is lower than the opening price. So they're very close together, then that suggests indecision in the market because the market doesn't know whether to go bullish or bearish, so whether there's more sellers or there's more buyers. And then the next one, the market decided there's going to be more people selling it, so not selling it, yeah, selling it. So the price of this continues to drop, whereby the closing price is below the opening price. So price of the asset drops, there's going to be more sellers than buyers. So sellers take control. Yeah, that's it. That's all that means. So that one, the closing price, which one? This is the closing price. So the closing price of that is pretty much, well, I want to say near the opening price of this candlestick, but it doesn't have to be. As long as it's beyond the middle point of this candlestick, then it should be fine. So but in this case this is like the closing price is near the opening price of that candlestick there, so kind of gone back in a loop, basically gone back to that state there, except this time the price is falling, not rising, right? So is that the correct way to analyze it? Because it shows indecision. There's indecision in the market in the middle, and it went back to how it was before the indecision. Right, next one, bearish harami. This is new. A bearish harami is a small black or red real body completely inside the previous day's white or green real body. This is not so much a pattern to act on, but it could be the one to watch. The pattern shows indecision on the part of the buyers. If the price continues higher afterward, all may still be well with the uptrend, but a down candle following this pattern indicates a further slide. Well, a further slide is in like it consolidating, is that what it means by a further slide? Bearish harami, so not hereish. Bearish harami is a small black or red, so small red real body completely inside the previous day's green real body. So this rectangle here is going to be inside within the edges of that rectangle there. This is not so much a pattern to act on, but it could be one to watch. Pattern shows indecision on the part of the buyers. A further slide. Oh, so does that mean it could go down? Small red real body completely inside the previous day's green real body. Not so much a pattern to act on, but could be one to watch. Pattern shows indecision on the part of the buyers. Pattern shows indecision on the part of buyers. If the price continues higher afterwards, all may still be well with the uptrend, but a down candle following this pattern indicates a further slide. If the price continues higher afterwards, all may still be well with the uptrend, but a down candle following this pattern indicates a further slide. Following this pattern indicates a further slide. Okay. So open, closing, open, closing. This candle here shows the closing was above the opening, so the price of the asset went up. Next candle, however, shows that the opening price was lower than the previous candle's closing price, and its opening price and its closing price was also lower than the previous day's closing price. So the next candle opens at a lower price than the closing price, than the previous day's closing price, and also closed lower than the previous day's closing price. So buyers, what is that? The buyers, indecision on the part of the buyers. So the buyers aren't sure if they should still be buying. So there's less demand for the product, or for the asset, I mean. So its opening and closing prices are below the previous day's closing prices. So they're not sure whether to keep the price rallying or not. Okay. Makes sense. Bullish harami is the opposite. So Rami, opposite of the upside down bearish harami, a downtrend is in play and a small real body, green or white, occurs inside a large real body, red or black, of the previous day. This tells the technician that the trend is pausing, and if it is followed by another up day, more upside could be forthcoming. So it's basically, the harami pattern is a reversal pattern then. So a small green real body completely inside the previous day's red real body shows the trend is pausing. So if followed by another up candle, so followed by another green candle, let's just say, followed by another green candle, more upside could be forthcoming. More upside could be forthcoming. So the pattern could continue to go up. Yeah, so if you look at here, the opening price is here, closing price is here. So this candle shows that the price dropped because the closing price was below the opening price, so the price of the asset fell. In the next candlestick, however, the opening price is below the closing price, so the price or the closing price is above the opening price. So the price of the asset went up that day, and also the opening price also opened higher than the previous day's. No, it didn't. It opened lower than previous day's opening price, and it closed lower as well. But it still shows that it opened higher than the last day's closing price, and it also closed higher than the last day's closing price. So the price could signal a reversal. So the sellers are losing control, and then the buyers, and there's beginning to be an increase in the demand of the asset. So the price could signal upward trend. Okay. In the next video, we're going to go through the bearish harami cross and etc. Laters.